Hi, welcome to PSL Demo Day. I'm Jason DeBacker, an associate professor at the University of South Carolina and president of PSL Foundation. Today, I want to share an update on the TaxBrain model. TaxBrain is an integrator app. That is, it takes a couple models in the PSL catalog, namely Tax Calculator and the Behavioral Responses models, puts them together, and allows for an easy user experience to produce traditional and dynamic revenue estimates. What's new to TaxBrain recently is the addition of an ability to distribute the corporate income tax across individual taxpayers. So I want to share a little bit about the theory behind that corporate income tax incidence distribution, and then show you how it's implemented in the TaxBrain model in case it's useful for your analysis. So first thing I'm going to do, I'm going to share a screen that's going to show the documentation for TaxBrain, where a new section has been added about distributing the corporate tax. The section starts off with those theoretical considerations. That is, what is the incidence of the corporate income tax and who do we think bears it? So I guess one saying we have in public finance economics is that only things that feel pain can bear the burden of a tax. And that is to say that it's ultimately people that bear the burden of all taxes. Even if the statutory incidence, like for the corporate income tax, is not on a person, i.e. it's the corporation that writes the check to the government. The ultimate burden of that tax is paid by humans, either employees of the corporation, its owners, i.e. shareholders, or its customers. All right, so knowing that, we can understand that the incidence of the corporate income tax is going to fall on people. Now, the next question is, which people is that, right? So we basically have three groups that it could fall on: employees, consumers, owners. All right, so why might it fall on the owners? Well, of course, when the corporation writes the check to the government, that's taking away net income from the corporation that can now not be distributed to its owners through dividends or realized through capital gains, if that money were retained and not distributed as dividends. It might fall on employees because as the corporation has less net income, it may pay its employees less. Finally, it could fall on consumers as a corporation that pays a higher tax may try to pass through some of that tax onto its customers through higher prices. Right? Now, those second two mechanisms, changing wages or changing prices, we think take some time. There's this idea in economics, and I think it bears out in reality, that prices are sticky. That is, they don't change very quickly, right? We've lived through high inflation recently, and we could think about our experiences as at the grocery store. We didn't see prices creep up. The price of deli meat, for example, it didn't go up 2 cents each month. It was just all of a sudden it jumped $1 or $2 per pound, right? So prices are inflexible in some ways and take a while to adjust. And that's true for prices consumers face as well as prices reflected in labor markets, that is wages. So we think it's going to take some time for the incidence to be passed on to people who are not the owners, because of course the owners, as soon as the corporation writes that check, paying their income tax, that's just less money left over to distribute to the shareholders through dividends or retain and therefore be realized through capital gains of those shareholders. So we think ultimately that the distribution across these three potential groups is going to take some time and probably first be borne by the shareholders and later be borne by employees and perhaps customers as well. Okay. Another thing we'll say too, with respect to these theoretical considerations, is it depends upon, of course, how flexible some of these markets are, or how competitive these markets are. So kind of the consensus is that it's very hard for corporations to pass through tax increases or decreases to their output prices. And that's because we think that goods markets are quite competitive. And if corporations try to raise their price, then non-corporate entities would be able to pass the tax. Non-corporate entities not paying this corporate income tax could undercut the corporate price. And so we think that it's very unlikely in general that the corporate income tax is going to be passed through to consumers. All right. Okay, so that basically leaves us with two groups: owners and employees. And now let me speak about owners a little bit more, because something we might think about is that corporate income tax and how much of that incidence is borne by owners. It's going to depend, whether you're a shareholder in that corporation or just the owner of capital generally. And I spoke of the story with the corporation writing that check to the government, leaving less money to distribute to its shareholders. But there's equilibrium effects, right? Because other owners of capital might be affected by this. And this is particularly true as corporations try to shift the burden away from themselves as a result of the change in corporate income tax. Corporations might, for example, put some of their operations offshore, outside of the US, not facing the US corporate income tax. And that's a way to shift the burden away from them. And in that case, right, you might be shifting the burden to, or having some of the incidents pass through to owners of capital broadly, or shifted overseas to owners of foreign capital. All right. But those changes in the location of capital, the amount of capital a corporation has, and so on, are, again, like the changes in wages, they're going to take some time. So we're thinking ultimately employees and owners of capital generally are going to bear the burden, but in the very short run, it's owners of the shareholders of the corporation that are going to bear the burden. Okay, so those are some of the theoretical considerations that have been taken into account in this tax brain implementation of the distribution of the corporate income tax. Now, when we get to its implementation, essentially tax brain is going to allow you to decide among three groups what share of the corporate income tax is going to be borne by those three groups. And those three groups are defined by labor income share, meaning essentially how much of the burden falls on wage earners, shareholder share, which is how much of the burden falls on owners of the corporation, those realizing dividend income or capital gains as owners of corporations, and then a return to all capital owners, and the share of that is, or the share of the incidence that is borne by owners of all capital, because again, these corporate income taxes are going to have equilibrium effects on other capital owners as well. Okay, so for instance, owners of non-corporate businesses or owners of foreign capital. So one of those inputs to the tax brain model that's going to be user defined are going to be those shares. What fraction of the corporate income tax is borne by wage earners, owners of capital, or owners of corporate capital, excuse me, and then owners of all other capital. Besides that allocation of the incidence, and this is going to really refer to that long run incidence. So after there's time for wages to adjust or capital to move, and so on. The second thing you'll define then is how long does it take to get to this long run? Okay, so the second key in this dictionary is going to be what's called long run years. And that's essentially going to be a value you place kind of based on your assumptions or your understanding of how quickly markets might work. Now there's just, to be sure we're kind of consistent across changes, there's going to be just 1 year. What is the long run when this incidence is fully shifted to labor or owners of other capital? In the immediate term, it's going to start and be 100% of the incidence is going to be borne by those shareholders in the corporations. When you define the long run years, say it's 10 years from now, what tax brain is going to do is allow for a transition over time from 100% of the burden being borne by owners of corporate capital. And then over time, that will shift. So if you're having this long run years be 10 years, over 10 years, that 100% is going to dwindle down as the increasing share is borne by labor and owners of other capital to whatever values you specify in the incidence input argument. Okay, so you're going to basically give tax brain two things. What's that long run distribution of the corporate income tax incidence look like across employees, owners of corporate capital, and owners of other capital? And then you'll specify how long does it take to get there. Tax brain will then infer over that period of time, be it 10 years or 5 years or 20 years, what the incidence in each given year looks like. Okay, so you'll be able to see a change over time in this distribution of the corporate income tax. Okay, so those are the assumptions for the distribution. You will, with this, also specify a corporate revenue argument. And so what this is going to be is, it could be any kind of tuple will work. So you could specify a list of corporate income tax revenue, And the only caveat is that the list you specify has to be the same length as the budget window you're going to analyze in TaxBrain. So if you're doing a 10-year budget window, TaxBrain is going to look, if you specify something for corporate revenue, that has length 10. Okay. One estimate of the corporate income tax revenue from each year. Okay. Because TaxBrain is going to take those revenue estimates of what the burden of corporate income tax was in dollars, and then split that across labor and capital. Okay. All right. So that's essentially how TaxBrain is handling this. Again, allowing you to be flexible with your inputs of whom you think bears the incidence of the corporate income tax. And then you putting in your understanding of how long it takes for that transition to happen. And what TaxBrain is going to do is take this corporate income tax amount and spread it across those different groups, employees, shareholders, owners of other capital, in a way that's consistent with your incidence assumptions. Let me see, we have an example built in. So in the TaxBrain example notebook, which we're reviewing here, but if you clone and download the TaxBrain repo, you can run on your own. We've added to this example notebook, which already walked one through a static reform and a dynamic revenue estimate. I'm sorry, static revenue estimate and a dynamic revenue estimate. It also now runs through a dynamic revenue estimate with the distribution of the corporate income tax. Okay, so this gives an example of how one could do this. So just hypothetically, what this example is looking at is, let's assume $5 billion in corporate income tax revenue each year for the whole budget window. So here you can see it's just kind of end year to start year minus +1. So we get the full budget window. We're just, for simplicity, assuming $500 billion in each of those years. Of course, ideally, what you want to do is pair this TaxBrain model with a model of your own, or say a JCT score of a corporate income tax change, and you can put those revenue numbers in here. Again, just making sure that your list of corporate income tax revenue is as long as the budget window you'll analyze. Next is that incidence assumptions dictionary, where we're specifying that in the long run, labor bears 50% of the burden, owners of corporate capital bear 40%, and owners of other capital bear 10%. And then we're saying, okay, how long is it going to take to reach that long run incidence? We're assuming here 10 years. Okay, we specified those revenues and assumptions, and now we're just going to pass it in to our tax, when we create this instance of the TaxBrain class, we're just going to pass as arguments here that corporate income tax revenue and those corporate incidence assumptions. Okay, nothing else has changed. We're using the same arguments in terms of what data we're using, what the reform we're looking at, the individual income tax reform we're looking at looks like, what kind of behavioral assumptions we're assuming. We've just added these two arguments, corporate revenue and the corporate incidence assumptions. Once we've instantiated that TaxBrain object, we use the run method, and that's going to produce a number of results. And what are shown here is just weighted totals of the income tax liability across years. Okay, and so we've got kind of our table of revenue estimates over the budget window. We could probably do a better job formatting this and put it in billions, say. But this is going to now include the effects of that corporate income tax. That is, for example, with $5 billion more in corporate income paid, or excuse me, in $5 billion more in corporate income tax paid, that's going to reduce by $5 billion the amount that can be distributed to shareholders, or the amount of wages that can be paid out by these corporations. And so if we take the first year, when 100% is borne by those corporate shareholders, we're going to see, we don't see it in this table, but it is indirectly reflected through the revenue estimates, that shareholders are going to have less income. Okay, dividends and capital gains in total are going to go down by $5 billion in that first year in 2021. Their lower income means there's going to be lower revenue from capital gains taxes or from taxes on dividends. Okay, so that lower revenue would be indirectly reflected in this table. And again, over the budget window here, so over 10 years, there's going to be this transition of more of that incidence being borne by labor or owners of other capital. And so you would see, if we looked at kind of distributions of different types of income over this budget window, which you could produce with TaxBrain, you would see that the amount of wages paid or capital gains realized are going to change over that budget window. Okay. So that's going to help you do a couple things. One, it's going to lead to more accurate revenue estimates, because you're going to essentially be accounting for what's sometimes called in revenue estimating the offset. That is the fact that with less corporate income, with this fixed GDP assumption, that's going to lead to less wages for consumers, or less wages for employees, or income for shareholders. And then the other thing that is going to be interesting here is that you're going to have these distributional impacts. So this was just illustrative, this example of how to use the new corporate income tax incidence assumptions. But you can, again, once you've run TaxBrain, you can pair this with like the distributional table, and you can see the distributional impacts, because, for example, a lot of the shareholder income is realized at the top end of the income distribution. So that corporate tax incidence is going to hit much more at the top end of the distribution and less at the lower end of the income distribution. And so you'll be able to analyze distributional effects as well of corporate income tax changes. All right. So all of those features of TaxBrain that are available when you're analyzing the corporate income tax incidence. Okay. Last thing I'll note here, and just to keep this all brief, is now you might be saying, okay, well, this is a fixed GDP assumption, and that's true. And that's true of what are called dynamic scores in traditional revenue estimating. But one could do a truly dynamic revenue estimate as well with a corporate income tax change. Now, the way to do that, and this would be true of any dynamic estimate that you would want to do with TaxBrain, is the way to do that is going to be to change some of the assumptions, which is another argument here for the TaxBrain class. And you could change the underlying growth assumptions of the economy. So what you'd want to do, if you were thinking, for example, that this corporate income tax change, an increase of $5 billion a year, maybe has effects on capital accumulation, and the trajectory of the US economy is then impacted, you would want to update the growth assumptions underlying the individual microdata. And what that would do then is that would change in your reform scenario, that would change the growth rate, say, of corporate profits or GDP in a way that is consistent with this new policy. And that would update and be reflected in these revenue estimates as well. Okay, so you can do fully dynamic revenue estimates with TaxBrain that may become more relevant as we're thinking about corporate income tax changes than individual changes. But the way to do that is just as you would do before, by changing the underlying assumptions, i.e. the growth assumptions used to extrapolate the microdata. Okay, so that's still available, may be, again, more relevant with the corporate income tax changes that you could be analyzing here. And so I wanted to mention it, but for examples of that, you can just look for some of the other examples of how to use TaxBrain and how to specify those assumptions, which you can find in this documentation or in examples in the GitHub repository. All right, so we're excited about this new tool, this new application of TaxBrain, and what one can do now to, again, look at more holistic impacts of tax changes, the individual side, now linking it to the corporate income tax as well. All right, so thanks for your attention. When I put this up on YouTube, I'll put some links to the TaxBrain documentation. We've had a couple really great demo days by the developer of TaxBrain, Anderson Fraley, and I'll put links to those demo days as well to give you more of an illustration of how to use the basic features of TaxBrain to produce, again, static and dynamic revenue estimates. All right, so thanks for your attention. We'll see you in a few weeks.